Hello, welcome to Geojit Spotlight. Welcome to yet another episode in this learning series. In this episode, we will examine taxation of income from stock market investment and trading. Which are the important taxes imposed? What are the tax rates? Are there any exemptions? How losses can be set off against gains, and such other details. Income from stock market investment and trading can be broadly classified into three categories, very broadly. 1. Dividend. 2. Capital gains. And 3. Speculation income and business income from trading in stocks and also trading in futures and options, derivatives. So let us look at each of these three different types of taxes. Dividend income is added to the income of the taxpayer and taxed at the appropriate rate. Appropriate rate means the rate at which the income is paid by the taxpayer, depending upon the tax slab of the taxpayer. So, if the taxpayer is in the 5% tax bracket, he or she will be paying 5% tax on the dividend income. If he or she is in 30% tax bracket, 30% tax will have to be paid on the dividend income. So it is simple, it is added to the income of the taxpayer and taxed based on the income slab and bracket. Second category is capital gains. Capital gains accrues when a stock or a mutual fund, equity mutual fund or a hybrid mutual fund, all these three categories are taxed similarly. When your selling price is higher than the purchase price, there is a capital gain. So this again can be broadly classified into short-term capital gains and long-term capital gains. If a stock or an equity mutual fund or a hybrid fund is sold within a year of purchase, it is called short-term capital gains and the tax rate is 15%. If the stock or the mutual fund, equity or hybrid is sold after 1 year, after 365 days, it qualifies as a long-term capital gains. And here, you don't have to pay, in long-term capital gains, you don't have to pay tax up to 1 lakh capital gains in 1 year. So long-term capital gains up to 1 lakh are totally exempt, and beyond 1 lakh, long-term capital gains are taxed at 10%. So this is a very attractive proposition. So if a taxpayer is even in the 30% tax bracket, on her long-term capital gains, she pays only 10% tax on the capital gains exceeding 1 lakh. It's also important to know that just like capital gains, there can be capital losses also. So short-term and long-term capital losses can happen if your selling price is lower than the purchase price. Here it is important to understand a very important distinction between taxation of short-term and long-term capital gains regarding set-off. Long-term capital losses can be set off against long-term capital gains, only against long-term capital gains. But short-term capital losses can be set off against short-term capital gains as well as long-term capital gains. This is an important point of distinction. And the capital losses can be carried forward for a period of 8 years. This is important in financial and tax planning. The third category is taxation of income from speculation and trading in derivatives. Now these two are treated differently. Income from intraday trading, what we call day trading, buying in the morning and selling on the same day before the market closes, or shorting in the morning and buying back before the market closes on the same day. That is intraday trading, and the gains are treated as speculative gains, and it is added to the income of the taxpayer and taxed at the appropriate tax slab level. Regarding income from trading, particularly derivatives trading, futures and options, that is treated as business income. And the important points of differences are between speculative income from intraday trading and business income from futures and options, derivatives trading. There are two important points of difference. Number one, speculative income, if it is a loss, negative income, it can be carried forward for a period of 4 years. Whereas business losses from trading in derivatives can be carried forward for a period of 8 years. That's an important point of distinction. There is another important point of distinction, and that is speculative losses from intraday trading can be adjusted against speculative gains from intraday trading, but business losses from derivatives trading can be adjusted against business losses, other types of business losses, interest, income from property, and such other incomes except income from salary. This is a very important point in tax planning. Now, apart from these three important taxes and the way they are treated, it is also important to understand that all stock market transactions are taxed. Then this tax is known as Securities Transaction Tax, or STT. So when you buy a stock, either for investment, short term, or for long term, or for intraday trading, you have to pay a tax. But the tax rate differs. For delivery-based transactions, tax rates are different compared to tax rates on intraday trading. Similarly, tax rates on derivatives trading also are different. So that is Securities Transaction Tax. These are broadly the taxes on income from stock market investment and trading. The important point is that if investors understand these nuances relating to taxes, the setting off of the losses, capital gains, long-term, short-term, how they are set off against each other, the distinction between speculative income, business income, etc., it is possible to minimize the tax burden. I'll just give one example. I know of a family which submitted their income tax returns last year. The family has 4 demat accounts. The father, the mother, and 2 grown-up children. All the 4 have demat accounts, and in these 4 demat accounts they have claimed long-term capital gains of 4 lakhs. For that family, 1 lakh each approximately, but not exactly, approximately 1 lakh each of long-term capital gains has been booked. And what is the tax incidence? The burden of tax? 0, because up to 1 lakh long-term capital gains are completely exempt from tax. So understanding the nuances of this taxation will help us to minimize the tax burden. Happy investing.